For this mock exercise, we're going to take a look at a case called Electronics, Inc. We're going to take a look at the difference between absorption costing and variable costing, and how the two different methodologies affects income, and depending on which method of valuation we use. We're going to take a look at this question. So this question starts with a company called Electronics. Electron Inc. is a semiconductor company, and it's based on Winnipeg. In 2013, it produced a new router system for its corporate clients. The average wholesale selling price is $1,200 each. So that's the sales price. So let me write that down. And for 2013, Electron estimated it will sell 10,000 routers, and they produced 10,000 routers. So sales and production equals 10,000. 2013 actual sales is 8960. So these are important information to note. And these are the following costs for 2013. So they broke out between variable and fixed. And you've got variable manufacturing, such as direct material, direct labor, and manufacturing overhead. And there's the marketing here. Variable marketing cost. And of course, the fixed cost are as follows. The first part of the required asks us to calculate the operating income under variable costing. The second part asks us to look at the absorption costing. Now it says here each router produced is allocated 165 in fixed manufacturing overhead. Now in previous chapters, you would have actually know how to calculate this 165. But for this question, it's given to us. But in other chapters, you would have already had, I've already taught you guys how to calculate the 165, the allocation of fixed overhead. If the product volume variance is written off the cost of goods sold, and there are no price, rate, or efficiency variance, calculate the operating income under absorption costing. And part 3 asks us to explain the difference between 1 and 2. So let's take a look at the first 3 parts to the question. So the first part is variable costing, right? Variable costing. So let's start with revenue. How many were sold? It was 8,960 units times the sales price is $1,200 per unit. That was given to us. Is 10,752,000. Okay? Now, again, we want variable cost. Let's start with the manufacturing cost first. Beginning inventory. We were told that this is new. In 2000, it produced a new router, so the beginning would be 0. Okay, then we need to add the variable manufacturing overhead. So let me just short form to MOH. So how do we calculate the variable cost? So the variable manufacturing overhead is going to be 55 plus 45 and 120. So this actually is 220. That's the variable manufacturing overhead per unit. So that's what I'm going to use. Okay? Now, the number of units produced was 10,000 units. That gives me 200,000, right? 2,200,000. And this gives us available for sale. We're going to deduct ending inventory. How many units are in ending inventory? Well, let's do a really quick math, right? So beginning inventory 0 plus production 10,000 minus 8,960 is sales, right? So beginning inventory plus production minus sales gives me ending inventory. In this case, it would be 1,040 units. So that's how much ending inventory I have. So we're going to take 1,040 units times 220 per unit to give me 228. So this is 2000. Okay, we're going to subtract 228,800 to give us variable cost of goods sold. Now we're going to add to that. So let me just kind of highlight this. This is how we calculate ending inventory. And this is actually for this one, right? So let's calculate the, so we need to add the variable marketing, right? And we're told the marketing variable is $75 per unit times 8,960 to give us total variable of 8,108,800. Okay? Now, we're going to take a look at the fixed cost. So let me just highlight that in yellow. So what are my fixed costs? Well, first of all, I've got fixed manufacturing overhead. That was given to us, 1,471,680. Fixed, you've got fixed R&D, and that was given to us as well, 981,120, and fixed marketing. That's 3,124,480. 5,577,280. So our operating income is $2,531,520. Okay? So that is variable costing. So let's move on to absorption costing. Absorption costing requires us to calculate gross margin. So you got revenue, it should be the same. So that revenue should be the same as variable costing, But this time we're going to calculate cost of goods sold, which is a combination of both fixed and variable. So starting with beginning, that would be 0. We saw that, right? Now, what are my variable manufacturing overhead? We know that the variable was $2.20 times 110,000 units, right? Now we need to calculate the allocated fixed manufacturing overhead. Now that was given to us, remember? We're told it's $165 times 10,000 units. This is given. And this is based on budgets, right? This is going to be based on what we think we're going to produce, what we think our manufacturing overhead was going to be at the end of the year. We calculate a per unit manufacturing overhead fix, and we allocate to the individual products, and that number comes to 165. So that's 161,650,000. The sum of this is 3850, and that would be my goods available for sale. Okay, now we're going to deduct ending inventory. Now we know that the ending inventory, we calculate number of units, right? We did that earlier in the previous one. We knew that ending inventory is 1,040 units times the per unit cost of 220 variable plus the 165. So here it's going to be 400,400. Now, we need to also, because remember we were told that the product volume variance is written off the cost of goods sold, we need to calculate the product volume variance. Now, how do we calculate that? The product volume variance is equal, so let's call this PVV. So PVV equals, what did we allocate? We allocated 1,650,000, right? Which is 165 times 10,000 equals 1,650 minus what was the actual. What's the actual? That was given to us, 147,1680. So we over-allocated, right? We over-allocated by how much? The difference is 178,320, and that's a favorable variance because we expense more than it actually incurred us. So in this case, we're actually going to add, in this case, 178,320. We're going to deduct a favorable variance. So what we're going to do is we're going to say, take the goods available for sale, subtract 400,400, add 178,320 to give us 327,180. And this is gross margin. So let me just put these aside. So this is to calculate this number. So we're going to take this number A, B, and C. This number basically is A minus B plus C because it's a favorable variance. Okay, so that is your gross margin. Now, we're going to take a look at the operating cost. Operating cost is, first we have variable marketing cost. And variable marketing cost was $75 times 8960 units to give us 672. We've got fixed R&D, and that's given to us at $981,120. And fixed marketing, $3,124,480. So the sum of that is $477,600. We're going to subtract these two. You get operating income of $2,703,120. So this is going to be D, and this is E. So it's going to be D minus E. So we've got, so let me do a recap, absorption costing. This is the hard part of it, because this is called the product volume variance. And this only exists, if you remember the previous video that we did called Rahe, the case called Rahe, we saw that product volume variance exists only in absorption costing, not variable costing, because we determine a per unit allocated fixed cost that we're going to use to value the ending inventory, and the more we produce, the more we allocate that artificial fixed overhead per unit. We're going to compare it to what we actually spent on fixed overhead, and you'll see that what we spent was less than what we allocated. That's why we have a favorable variance. That favorable variance, we're told, is allocated all to cost of goods sold. And that's why we are adding it, okay, to determine our gross margin. Okay, so let's look at the part 3. Part 3 says, what are the difference? Calculate a numerical difference. So we know that the operating income under absorption is $2,703,120. That was in part 1. Operating income under variable, sorry, that's part 2. Okay, and in part 1, it's $2,531,520. And I expected this to be higher because we end up having an ending inventory of 1,040 units. So the variance, the difference, is 171,600. That difference should be the ending inventory, the fixed manufacturing overhead in ending inventory minus fixed manufacturing overhead in beginning inventory. Now, what is the beginning? What is the ending inventory is 1040 and the fixed was 165, wasn't it, per unit? That was given to us. This equals 171,600 and the beginning is 0. Gives you 171,600. So that's the difference. That is the reason for the difference. So the 2013 operating income under absorption costing is going to be greater than the variable costing because the 2013 inventory increased from 0 to 1,040 units, and under absorption costing, fixed overhead remains in ending inventory. It gets capitalized. This is how much is capitalized in that ending inventory, which will result in lower cost of goods sold relative to the variable cost. Now, let's look at the actual final part 4 of the question. It says, electrons managements consider implementing a bonus for supervisor based on gross margin under absorption costing. That's what they want to do. What incentives will this create for the supervisors? So we know that there are pros and cons associated with using absorption costing as a performance measure for electron supervisors. So we know that under the absorption costing, it takes both fixed and variable cost, and that supervisors can control their income based on how much they produce. So they can actually shift and flex income up or down depending on the level of production. Now, the downside of using, that's the actual downside, isn't it, of using absorption costing. Now, so do you think it's a good idea to base on there? Well, the thing is that we need to add other performance measures to prevent manager or to counter-react management's motive to increase inventory levels by perhaps charging them carrying charge for holding inventory, or we'll look at different non-financial metrics such as ratios that includes inventory in the calculation of these financial ratios that will prevent management for accumulating inventory. So we can take a look at some of those compensating measurements that will decrease the temptation to using inventory to manage profit. Okay? Thank you.